update the chart guys, latest technical charts as well. Now, if you haven't downloaded our newsletter this week, it looks like this. You can scan the QR code that's on the screen right now to download that. It's out every week, and also you can download that from our app as well. In terms of market movers, a bit of red across a lot of global markets last week. The US markets are down in the red, mostly coming from the fact that the US job numbers came in a little bit stronger than expected. And I think the lead up to that, we actually were expecting rates to be cut much sooner. So I think that is putting some pressure in terms of the outlook for interest rates in the US. Hong Kong is also down, particularly on weakness of some of the tech stocks there. ASEAN was fairly mixed with the STI flat, but the KLCI powering through into the green. Quite a few markets closed today: China, Hong Kong, Taiwan, Australia as well. So let's watch out for the rest of the week in terms of how these markets perform. Now, let's talk about strategy and stocks, right? I mean, Singapore has been out of favor at the first couple of months of this year, partly from where interest rate expectations were. But now we've just published a brand new report where we've actually upgraded our STI target for the end of the year to 3,583 from 3,290. Now, this is about a 7% upside from where the STI is currently. Now, a large part of this is predicated on Fed interest rates. Now, if you dial back to around January of this year, we were expecting around 5 to 6 Fed cuts. Now, Fed cuts have fallen to 2 to no cuts, and that makes a huge difference. Why? Because Singapore as a market historically outperforms when interest rates are high. You can see that from the first quarter corporate performance as well. We had just come out of results season, and we've done some analysis of the results season for you. Market earnings are up about 8.3% on a year-on-year basis. That's the fastest Singapore's market earnings grew since the second quarter of 2023. Largely, this was led by the industrials, the banks, a lot of the small and mid caps actually coming into support as well to drive this earnings growth. Nearly a third of our coverage universe actually delivered earnings that was ahead of expectations. And the proportion of disappointments actually fell to 16% versus around 22% in fourth quarter of last year. Now, at the same time, more importantly, forecast downgrades, so these are the downgrades that analysts do after the results come in, actually fell to 17% of our total universe. Now, if you remember back in fourth quarter, this was around 43%, and most of that was actually led by the REITs. So things are seeming to be stabilizing in the REIT sector as well. So that's something that we can ask Krishna when he comes online later. So all of this to us points to the fact that the earnings downgrade cycle is bottoming for the STI, and we actually expect that the higher pace of earnings for the STI going into 2024 is a lot more clearer now. We've seen that overall STI earnings will grow by about 5.6% for 2024. We started the year with only about a 4% growth. So already seen a bit of a nice upgrade to that numbers. For our regular viewers, you'll remember that back around January, February this year, we were saying that the risks for the STI is for earnings to be upgraded as the year progresses. Now, in terms of sectors and so on, we are positive on gaming, on industrials. We are also positive on some of the small and mid-cap names, as well as the telcos. Why? We see 4 big themes playing out for this year, as well as for the next year as well. The first is corporate restructuring. Now, you'll be very familiar with the corporate restructuring that Sembcorp did, Keppel, CapitaLand, a few other of GLCs have done. We also see Singpost mentioning restructuring as well. We think more restructurings will happen across the GLCs, but also some of the large corporates that should improve ROEs going forward. The second theme is the Johor Singapore Special Economic Zone. We did do a special show on this a few weeks back, but we think this is going to be a game changer if this happens, and that's going to really drive synergies across companies in Singapore. The third is a huge spending Singapore is going to be doing and already doing in decarbonization as well as lowering emissions. I think this is going to have a significant amount of opportunities across a lot of stocks, particularly in the industrial space as well as in the banking and the small and mid caps as well. And finally, AI. I know this is become a very common theme, but we think that especially for Singapore, where a lot of companies have been spending ahead of the curve in terms of AI, we will start to see the productivity improvements coming from these technologies a lot faster than most of the other ASEAN markets. Something to watch out for. We are already seeing a lot of institutional money going into these sectors so far this year. So again, we are starting to see that money being put to work. So how does this translate into stocks? We've got top 10 stocks that we are highlighting for the second half of this year, and most of them are actually tied to these themes, as well as some of these stocks have been laggards last year, and we think the story is actually quite strong, that it deserves quite a bit of attention now. In terms of themes, we like DBS, Dynamac, Marco Polo, Sembcorp, Singtel, as well as ST Engineering. On the laggards, we like CICT, Franken, Genting Singapore, as well as StarHub. Now, you'll notice that we only got one REIT in that mix. So let's bring Krishna in. I think it's a good time to bring Krishna here right now to talk about the latest outlook for the retail as well as the hospitality REIT sector. Krishna, thanks for joining the show. Now, you mentioned that the Taylor Swift effect is wearing out for the hospitality and the retail REITs. What do you mean by that?
First of all, thank you, Thilan, for having me once again. So yes, we are seeing some of the impact that we got in March starting to cool off. The March saw the visitor arrivals at 1.48 million, which is a record peak that we saw since the opening up of the economies. But since that, I think in the April number, if you see, it has come down to 1.35 million. So we are seeing some of the impact that came from the concerts starting to wear off. Even if you see the first quarter, where quite a bit of concerts were organized, even in the month of Jan, the overall tourist arrival was 4.3 million. It was just shy of 4.6 million that we saw in 2019 in the same period. So these events did have an impact on overall the hotel statistics as well as the retail consumption, and we saw that to be cooling down in April. So I think that will have an impact on these particular operating stats.
Got it. So do you foresee that now that you're seeing this sort of weakness in numbers, is there worse to come for the subsector if retail sales as well as RevPAR for the hospitality side continues to slide?
Yeah, I think if you look at the first quarter sort of the briefings, so there were questions on the forward bookings, and management for the hotel REITs have indicated that 2Q will be soft. But in the second half, they are seeing encouraging signs of forward booking. So in my view, I think the room rates will come off in subsequent months, and we should not be surprised by that. For retail, we are entering into a phase where the school holidays are beginning and local residents will travel abroad. So there will be some seasonal softness for the retail sales as well in the 2Q. But beyond that, we think the retail sales will be steady as long as the local employment stays supported and the government measures to offset inflation is also in place.
Right. I mean, employment seems to be very well supported so far. And I think also the government support seems to be fairly well entrenched as well. Now, so within that, in that context, how should investors be positioned? And what are your top picks at this stage and why?
Yeah, I think so. I think for the REITs, the interest rates do play a fairly large portion. What we are seeing is that the interest rate world, we are still seeing cross currents in that. You saw last week, Europe and Canada actually cut the rates. UK is supposed to cut the rates as well. But on the other hand, we are seeing quite strong data from US. Even closer home, the 6-month T-bill, the cutoff yield was 3.76%, which is 11 basis points higher than the prior cutoff yield. So it's a bit of a mixed signal on that front. So yeah, I know I'm sounding like a broken record here. So my view is unchanged. We are still maintaining a neutral stance on the REIT sector, and our preference is for the liquid large cap names. So our preferred pick is CICT. It is 90% of the income is from Singapore, so no FX risks. It is a A-rated credit, so a lot of comfort there in this high interest rate environment. And further, it has a diversified exposure to both office and city center retail as well as subsector suburban retail. So you get a diversified revenue stream without much of the downside risk which other peers are currently facing.
Right. And what about FCT? Is that also one of your picks?
So yes, FCT is one of the picks. Obviously, it is not as diversified as CICT, but it is exposed to the resilience of the suburban retail consumption that we have seen so far. And more importantly, I think given the trend that e-commerce is there and it is having a steady influence in terms of the proportion of retail sales that we are seeing, the REIT is proactively moving towards more of the prime suburban malls, which are likely to be a bit more resilient as long as the e-commerce continues to have the mid-teens kind of a proportion of the retail sales.
Got it. Actually, we've got a audience question here from John, who's asking if you're staying higher for longer. It is as simple as staying away from the REITs and going into the banks. I think just listening to Krishna as well, I think he's very clear that he's neutral on the REITs, and I think we need to wait to see some clarity in terms of where interest rates start to come off. While the banks will obviously benefit from better net interest income as interest rates remain high. So right now, from a relative preference basis for our Singapore market, we're actually neutral on the banks as well as the REITs, but we are more leaning towards the positive side on the banks than the REITs at this stage. I hope that answers your question, John, and thanks for writing in. Now let's head over to Indonesia. We've got Paulina Margarita on the line, and she's going to be talking to us about Astra. Paulina, welcome to the show.
Hi, thanks.
Hey, thanks for coming on.
Thanks.
Now, Paulina, can you bring us up to speed on why Astra has outperformed so much in the second half of last year?
Yes, so Astra share price has actually dropped for around 40% since its peak in June 2023. This was mainly driven by weak car sales occurring throughout second half of the year last year, where we see that car sales declined by around 13%. The week of four-wheel sales trend continued up to April 2024, where we see demand drop by 23%. A couple factors that actually contribute to this. We see one of the first is the weak purchasing power issue. in Indonesia, which has impacted a lot of consumer stocks as well, especially for the middle to lower class segment, since we see that the recovery trend after COVID is trending towards the K-shaped recovery. And then secondly, we also face natural tax implementation that has hindered the demand from corporate car buyers. This new regulation is implemented since July 2023, hence the weak demand since second half last year as well. And we also see some wait and see sentiment before election, which has slowed down the investment for corporates and their expansion plans. And since end of last year, the government has actually opened the room for imported EVs by offering incentive, a lot of lucrative incentive for imported EVs. So once the EV factories commit to open their factories by 2027 in Indonesia, they will get a free tax, imported tax, and also luxury tax, which we see was very lucrative in the first place. And after that, BYD also has entered the market since early 2024, which has put even more pressure for Astra since second half of last year.
Got it. So with all this pressure, why are you getting more confidence at this stage to upgrade the stock to a buy?
Yeah, I think at this point we are reaching near the trough for Astra in terms of the weak car demand. We should be looking at a much improved outlook in the coming months after the election and Ramadan season has already ended. A couple of factors that we think will support the demand improvement is the rising consumer confidence. We have seen the indicators such as consumer confidence index in Indonesia has already shown an uptick since April 2024, which we believe should be translated into an improved automotive demand as well. And secondly, we also see a better outlook for key commodities prices in Indonesia, especially as Indonesia is a heavily exporter for commodities such as coal, CPO, and nickel, in which prices has been pretty good throughout this year. We think this should have a positive spillover effect as well for the car demand. Thirdly, we also see the threat from EVs are moving slower than initially anticipated. So market previously was jittery after BYD's entrance, because BYD was proven very successful in grabbing the ICE market share in Thailand. They can grab the market share for in 1 year up to 8%. But in Indonesia, we think after monitoring the development in the past couple of months, BEV penetration has not moved that much. Our BEV penetration is currently standing at around 2.8% versus 1.6% last year. So we think that Indonesian market has not been open too much towards BEV development. A couple of factors that I think affecting the slow BEV penetration in Indonesia is firstly on the infrastructure. We have very few charging stations compared to Thailand. Only around 400 charging stations versus 2,500 charging stations in Thailand. And secondly, on the price points as well. A lot of cars that are most popular in Indonesia is priced at around $80,000 or lower. But for BYDs or other EVs products, a lot of their products are priced $35,000 or more. So I think in terms of purchasing power, Indonesia is not that ready yet for EVs. Hence, the EV threats, I think, has been subsiding a lot in the recent period. So, and in addition to that, I think despite all the competition and weak auto demand environment happening since last year, Astra has been proven to be very resilient. Their market share has been maintained at around 55% for the past 15 years. Valuation has been very cheap as well, at around trading at around six times PE, while offering 7% dividend yield. This valuation has been reaching at around its COVID level. So I think we are looking at the market. We are anticipating the market to correct the valuation for Astra, given that the company's fundamental performance has been pretty solid despite all the negative news that has been happening.
Got it. So cheap valuations, good dividend yield, a lot of the bad news priced in, the fundamental performance of the company actually holding up quite well as well. So a lot of positives going for that. So please do read Paulina's note in our newsletter today. Paulina, thank you so much for joining us.
Thank you.
Okay, so let's we're tight on time, so let's jump to Nick, the chart guy. Unfortunately, he can't be with us today, but he's got two technicals to show. The first is actually the STI, which I think is quite timely, and also a contrarian view to our earlier call on the market in terms of where the STI is heading. He thinks that the RSI for the index is actually in the overbought territory, and there could actually be some short-term consolidation. So on the fundamental side, we think that the STI will go up, but on the technical side, Nick thinks that there might be some short-term consolidation. So do read his report as well. Also quite timely is the S-REIT index that he's highlighting as his second idea. And also fairly contrarian. He sees that the current price structure is actually supportive of an upward movement, while we're a little bit more neutral on the sector. But the upward movement might actually be at a relatively slower pace. So again, I do suggest that you pay some attention to the technical charts in the newsletter today. Let's jump to the upcoming dates and events. We've got quite a few numbers that are coming out. Singapore's Nodex numbers out on the 17th of June. The all-important CPI numbers in the US out on the 12th. Singapore's inflation numbers out on the 24th of June, and industrial production, which has generally been fairly disappointing for Singapore, is out on the 26th of June. So watch out for those dates. In terms of events, we've got two events coming out on the 18th of June. We've got Elite Commercial REIT. It's a virtual event. You can register for that by scanning the QR code on the screen. We've also got a webinar on seminar on SRS, investing in SRS strategies for the future with Nikko Asset Management in partnership, which is on the 26th of June. You can register for that with the shortened bit.ly code on the screen. Unfortunately, that's all the time we have today. So thank you again for your support. Next weekend is a long weekend, so we'll see you. First of all, enjoy the long weekend, and we will see you on Tuesday at the same time for our show. Until then, have a profitable trading week. Thanks for joining us.